Hi guys! Enjoy John's analysis.
On the night of April 2nd, 2026, Donald Trump, the President of the United States, sat behind the Resolute desk and made a promise to the American people. Not a vague diplomatic statement, not a carefully hedged policy position, a specific, measurable, time-bound commitment that every market on Earth is now watching with a countdown timer. He said this: "We are going to hit them extremely hard over the next 2 to 3 weeks. When it's all over, the United States will be safer, stronger, more prosperous, and greater than it has ever been before. 2 to 3 weeks." That is the sentence this channel is going to spend the next 50 minutes unpacking. Because if Trump is right, a specific chain of market consequences follows, and those consequences point, with unusual precision, toward a single asset that is currently trading 46% below its all-time high, sitting in extreme fear territory, with the largest institutional buyers in the world accumulating at a pace not seen since April 2025. This channel does not evaluate military strategy. This channel does not predict geopolitical outcomes. What this channel does is read the data. And right now, the data is telling a story that the mainstream financial media has not fully assembled. Brent crude has risen 36% since February 28th, the day Operation Epic Fury began. The Federal Reserve held rates at 4.25 to 4.50% at its March meeting, with 95% of the market now pricing in another hold at the April 29th meeting, according to CME FedWatch. Goldman Sachs canceled its June rate cut forecast directly because of the oil shock and pushed its first cut of 2026 to September. And Bitcoin, the asset that this channel covers, is trading near $68,000, 46% below its all-time high of $126,000 set in October 2025. Those four facts are connected. They are connected through a transmission chain that runs from the Strait of Hormuz, through oil prices, through inflation, through the Federal Reserve, through global liquidity, through risk asset valuations, all the way to Bitcoin. Trump just said that chain has 2 to 3 weeks left. This video explains what that means, and what the people who have been through multiple Bitcoin cycles are already doing about it. No price targets, no financial advice, just the architecture of what is in front of us right now.
Hey guys, I need a quick favor from you. If you're enjoying this video, please smash that like button and hit the hype button after. It really helps the channel grow and tells the algorithm that this kind of deep macro plus Bitcoin content deserves to reach more people. Takes literally 2 seconds, but makes a huge difference for us. See you.
To understand why Trump's 2 to 3 week promise matters for Bitcoin, you need to understand the transmission chain that connects a maritime choke point in the Persian Gulf to the price of a digital asset trading on exchanges around the world. This chain is not theoretical. It is documented step by step in data published by the Federal Reserve Bank of Dallas, Goldman Sachs, the International Energy Agency, and CME Group over the past 30 days. Most financial media coverage of the Iran conflict treats it as an oil story, or a geopolitical story, or an inflation story. It is all of those things simultaneously, and each one feeds directly into the suppression mechanism that is holding Bitcoin 46% below its all-time high as of April 2nd, 2026. Step 1 is the Strait of Hormuz. Before Operation Epic Fury began on February 28th, 2026, 20 million barrels of oil per day transited the strait, equivalent to approximately 20% of global petroleum liquids consumption, according to the U.S. Energy Information Administration. The International Energy Agency described the subsequent disruption as the greatest global energy security challenge in history. According to Wikipedia's documented account of the 2026 Strait of Hormuz crisis, tanker traffic dropped by approximately 70% initially, with over 150 ships anchoring outside the strait to avoid IRGC attacks, before traffic collapsed to effectively zero. BCA research analyst Marko Papic estimated in a note published the week of March 28th that the world had already lost 4.5 to 5 million barrels per day of oil supply due to the war, and that number would double by mid-April, becoming the largest loss of crude supply in recorded history. Every day the strait remains closed is another day the oil premium stays embedded in the global economy. Step 2 is oil prices. Brent crude crossed $100 per barrel on March 8th, the first time in 4 years, and reached a peak of $126 per barrel according to Wikipedia's documentation of the crisis. Goldman Sachs, in a note led by analyst Don Striven and covered by Bloomberg, described the disruption as the largest ever supply shock for the global crude market and raised its average 2026 Brent forecast to $85 per barrel from $77 previously. Under Goldman's base case, Hormuz flows at 5% of normal levels for 6 weeks, followed by a gradual 1-month recovery. Cumulative oil losses would exceed 800 million barrels. Barclays warned Brent could test $120 per barrel if the conflict persists another few weeks, with a higher end scenario of $150. Chevron CEO Mike Wirth said publicly at S&P Global's Zero Week conference that there are very real physical manifestations of the closure of the Strait of Hormuz working their way around the world. That language, physical manifestations, is the language of a supply shock that cannot be resolved by sentiment or statements alone. Step 3 is inflation. Goldman Sachs estimates that a sustained 10% rise in oil prices raises headline PCE inflation by approximately 0.2 percentage points, while shaving 0.1 percentage points off GDP growth. With Brent up more than 36% since February 28th, the inflationary impact already embedded in the pipeline is not marginal. The Federal Reserve's preferred inflation gauge, core PCE, was already running above the 2% target before the conflict. Goldman now projects PCE inflation will end 2026 at approximately 2.9% under its base case scenario, well above the Fed's stated threshold for easing. The February CPI reading held at 2.4% year over year, according to Polymarket's April 1st summary. But that reading predates the full pass-through of the oil shock, which typically takes 4 to 6 weeks to show up in consumer price data. The inflation problem is not getting smaller, it is getting larger in slow motion. Step 4 is the Federal Reserve. Goldman Sachs explicitly canceled its June rate cut forecast because of the oil shock and pushed its first cut of 2026 to September. The CME FedWatch tool, which derives probabilities from federal funds futures contracts, currently assigns a 95% probability to a rate hold at the April 29th FOMC meeting, according to MEXC's analysis published the week of March 26th. The current federal funds rate target range stands at 4.25 to 4.50%. Polymarket traders on April 1st priced a razor-thin contest between zero cuts in 2026 at 30.9%, implied probability, and one cut at 28.0%, mirroring the March 18th FOMC dot plot's exact 7-to-7 split among members. The Fed is not cutting. The Fed is watching. The thing it is watching most closely is the thing that Trump promised would resolve in 2 to 3 weeks. Step 5 is global liquidity. And this is the step that connects directly to Bitcoin. Rate cuts are not just about borrowing costs. They are signals that expand the global money supply and compress the risk premium that institutional investors apply to assets further out on the risk spectrum. Bitcoin's largest sustained rallies, from March 2020, from January 2024, from November 2024, all coincided with periods of expanding global liquidity, falling real rates, or explicit Fed easing. The Iran war has done the precise opposite. It has created an inflationary shock that makes the Fed's job harder, delays the pivot that markets were expecting, and keeps the liquidity environment tighter than it would otherwise be. The result is visible in a single number: Bitcoin at approximately $68,000 on April 2nd, down from $126,000 in October 2025. A 46% drawdown driven not by any change in Bitcoin's fundamentals, but by the macroeconomic transmission chain that started with an IRGC warning transmitted on VHF radio to tankers approaching the Strait of Hormuz on February 28th. That is the suppression mechanism. Trump says it has 2 to 3 weeks left. The speech lasted 19 minutes. It was Trump's first formal primetime address about Operation Epic Fury since the war began 32 days earlier on February 28, 2026. Every major news organization covered the same headline: Trump says war is nearing completion. But the markets covered a different headline, because markets do not read speeches. Markets read signals. And on the night of April 1st, 2026, the signal that markets read was not the victory lap, it was the clock. Here's exactly what Trump said, because precision matters. He said, "Tonight, I'm pleased to say that these core strategic objectives are nearing completion. We are going to hit them extremely hard over the next 2 to 3 weeks. We are going to bring them back to the Stone Ages, where they belong. In the meantime, discussions are ongoing. Regime change was not our goal. We never said regime change. But regime change has occurred because of all of their original leaders' death. They are all dead. The new group is less radical and much more reasonable." Those 4 sentences contain the entire market thesis. 2 to 3 weeks. Discussions ongoing. New leadership in place. Less radical, more reasonable. Every word is a market signal, and not one financial anchor reading a teleprompter in a studio that night put all 4 of them together. The market's immediate reaction confirmed the sensitivity. According to CNN's live coverage, Brent crude spiked more than 4% to over $105 per barrel in the minutes following the speech, because Trump also said he would hit Iran's electric generating plants if no deal was reached, which the market read as escalation rather than resolution. Dow Jones futures fell 260 points. NASDAQ futures slid 0.8%. But that initial reaction missed the structural message in the speech. Trump had already told reporters on Tuesday, April 1st, the day before the formal address, that he expected the conflict to be over in 2 to 3 weeks, adding, "We will be leaving very soon," and promising gas prices would then come tumbling down. That was not the speech. That was the setup for the speech. And crucially, on the morning of April 2nd, the day this channel is publishing this video, Trump said on social media that he would consider a ceasefire request from Iran once the country opened the Strait of Hormuz, according to NPR's live updates. Okay, quick pause. If you're still here after the 10-minute mark, give yourself some credit. Most viewers drop off way earlier. The fact that you're still watching shows you have real discipline and serious interest in understanding these structural shifts. I respect that a lot. Quick favor while we're here. If you're enjoying this video so far, smash that like button. It really helps the channel and tells me what kind of content you want more of. And if you haven't yet, hit subscribe and turn on the bell so you never miss the next updates on Bitcoin's institutional path. Now let me know you're here. Comment with your city and country, what time it is right now where you are, how the weather is over there. I love seeing how truly global this community is. People watching from completely different time zones and climates, all in the same pursuit of clarity. It's one of my favorite parts of creating content. Go ahead and drop your comment below. I'll be reading them all. Let's continue the video. The ceasefire condition is now public and specific. Hormuz opens, war ends. To understand why that condition matters so much to Bitcoin, it helps to examine what happened on March 31st, 24 hours before the speech, when the market got a smaller version of the same signal. Iranian President Masoud Pezeshkian made a single statement confirming that Tehran had the necessary will to end the war provided certain guarantees were in place. According to a Kobesi letter, oil prices fell 5% in 3 minutes. According to CryptoRank, over $1 trillion in market cap was repriced within minutes. The NASDAQ surged 3.1%. Bitcoin moved from approximately $66,000 to reclaim $69,000, a 2.5% intraday swing documented by Crypto News. The S&P 500 gained 2.5% on the day, adding approximately $1.4 trillion in market capitalization according to Bitcoin News. The US dollar index fell nearly 1% below the 100 level. All of that happened because one man who is not the commander-in-chief of the United States said he was willing to negotiate. Now the commander-in-chief of the United States has given a specific timeline and a specific condition on national television, confirmed by NPR, CBS News, CNBC, CNN, and the Council on Foreign Relations. There is a critical distinction between March 31st and April 2nd that this channel needs to state precisely because the bear case lives in that distinction. Pezeshkian's statement on March 31st was not confirmed by Tehran's foreign ministry, which called Trump's subsequent characterization of the talks false and baseless, according to Al Jazeera. Iran's military command responded to Trump's April 1st speech by vowing to carry out more crushing, broader, and more destructive attacks, according to the Council on Foreign Relations. The Strait of Hormuz, as of April 1st, remained blocked, with Procurement Magazine reporting that Trump had paused energy plant strikes for 10 days until April 6th at Tehran's request, though Iran denied making such a request. The market is not pricing in certainty. The market is pricing in probability. And the probability just changed when the President of the United States gave a specific timeline on national television for the first time in 32 days of conflict. What this video is tracking is not whether Trump is right about 2 to 3 weeks. It is what happens to the Bitcoin suppression mechanism described in the previous block, the Hormuz Oil inflation Fed liquidity chain, if that timeline is approximately correct. The data from March 24th is instructive. When Israeli Channel 12 reported a potential one-month ceasefire being negotiated by White House envoys, Brent crude dropped from $104 to below $100 in minutes, and Bitcoin reclaimed $71,000 from near $69,000, according to CoinDesk. That was a media report of a potential ceasefire being negotiated. Trump's primetime address is the Commander-in-Chief of the United States, confirming a 2 to 3 week timeline directly to the American people. The signal is structurally different in magnitude, even if the underlying uncertainty remains the same. The market already demonstrated on March 31st and March 24th exactly how it will respond when the story resolves. The only open question is when. This channel does not make price predictions. What this channel does is read history, and history has a specific thing to say about what happens to Bitcoin when a macro suppression event resolves. The pattern is not identical across cycles, but it is consistent enough that ignoring it in the context of Trump's 2 to 3 week timeline would be a structural omission. There have been three major macro shocks in Bitcoin's history as an institutionally owned asset. March 2020, the Federal Reserve tightening cycle of 2022, and the Iran war of 2026. Each one tells a different piece of the same story. March 12, 2020, what the crypto community calls Black Thursday, is the cleanest precedent. Bitcoin was trading near $8,000. When the COVID-19 pandemic was declared a global emergency and global markets entered freefall, Bitcoin crashed nearly 40% in a single day, falling to approximately $3,850, according to Bankrate's documented price history. The suppression mechanism was identical to what this video has described for 2026, a global shock creating a liquidity crisis, forcing institutions to sell risk assets to meet margin calls, and collapsing the macro environment for anything perceived as risky. The Federal Reserve responded by injecting over $4 trillion into the economy. According to Bitcoin Magazine's documented history, the U.S. government's attempts to help the economy recover pushed the amount of dollars in circulation from 15 to 19 trillion over just a few months. Bitcoin, operating with a fixed supply of 21 million coins that could not be inflated to meet the new demand, did what fixed supply assets do in an environment of expanding money supply. It went up. From a low of $3,800 in March 2020 to $29,000 by December 31st of the same year. From $29,000 to $69,000 by November 2021. The suppression event resolved, the liquidity expanded, and Bitcoin compounded the expansion because its supply could not keep up with the new money. The second major macro suppression event runs from late 2021 through 2022, and it is the bear case precedent that this video must state honestly. The Federal Reserve announced in November 2021 that it would begin tapering its bond purchases. According to Bankrate's documented history, the prospect of less liquidity in the market threw risky assets, including Bitcoin, for a loop almost immediately. Then, in March 2022, as the Fed began aggressively raising rates, eventually by 550 basis points over the tightening cycle, Bitcoin fell from $69,000 to approximately $15,500. By November 2022, a decline of approximately 77% according to CoinTracker's historical analysis. According to 24/7 Wall Street's documented recovery analysis, Bitcoin did not reclaim its prior all-time high until March 2024, 28 months after the peak. The lesson of 2022 is the mirror image of the lesson of 2020. When the Federal Reserve tightens aggressively and liquidity contracts, Bitcoin falls alongside risk assets and stays down for as long as the tightening continues. The Iran war has created precisely that environment. Oil-driven inflation forcing the Fed to hold or potentially hike, compressing liquidity, suppressing Bitcoin alongside every other risk asset. The structural difference between 2022 and 2026 that this channel believes matters is the institutional ownership base. In 2022, Bitcoin had no spot ETFs, no systematic corporate treasury accumulation at scale, and no allocation from any major asset manager's flagship retirement product. In 2026, BlackRock's IBIT holds over 762,000 Bitcoin according to Strategy's holding comparison data. Strategy holds 762,000 Bitcoin at an average purchase price of approximately $75,694, according to CoinDesk. According to Caleb and Brown's documented market cycle analysis, as of early 2026, corporate treasuries held over 8.4% of total Bitcoin supply. The floor is structurally different, not because the macro environment is more favorable, but because the long-term, non-price sensitive buyers who entered through ETFs and corporate treasuries did not exist in the 2022 cycle. According to Mudrex's cycle analysis, Bitcoin's maximum drawdown has been decreasing as the market matures, from 93% in 2011 to 87% in 2015 to 84% in 2018 to 77% in 2022, with analysts projecting potentially 60 to 70% as the maximum drawdown range for the current cycle. Bitcoin fell 46% from the October 2025 all-time high. That number places the current drawdown within the historical range of a mid-cycle correction, rather than a full bear market capitulation, though CryptoQuant analyst J.A. Martin has noted that Bitcoin is 703 days post-halving, and historical cycle bottoms begin forming around day 777, placing a potential structural bottom in late May 2026. The halving cycle context matters because it establishes where Bitcoin is in its structural calendar, independent of the Iran war. The April 2024 halving reduced Bitcoin's new supply issuance from 6.25 Bitcoin per block to 3.125 Bitcoin per block. According to ARK Invest's analysis of halving cycles, each halving has been followed by a cycle peak approximately 12 to 18 months later. The October 2025 all-time high of $126,000 arrived approximately 17 months after the April 2024 halving, exactly within that historical window. What followed was a correction that, as of April 2, 2026, stands at 46% from the October peak. Historical halving cycles document that mid-cycle corrections of 40 to 50%, followed by resumption of the long-term trend, have occurred in every prior cycle. In 2013, in 2017, and in 2021, where Bitcoin fell 50% mid-cycle before resuming its climb to $69,000. The current drawdown, in the context of the halving calendar, is consistent with a mid-cycle correction rather than a terminal bear market, which is what the whale accumulation data in the next block confirms independently. The bear case that honest analysis requires stating here is that the 2 to 3 week timeline Trump gave is not guaranteed. Iran's military command vowed more crushing attacks after the speech, according to the Council on Foreign Relations. Iran's foreign ministry denied that negotiations were taking place. The Strait of Hormuz remained blocked as of April 2nd. BNP Paribas, head of energy strategy. Aldo Spanger said publicly that for as long as Hormuz remains closed, both oil and gas markets do not balance, and the demand destruction required to balance markets would require significantly higher prices than today. If Trump's timeline slips to 4 weeks, 6 weeks, or longer, Goldman Sachs' adverse scenario puts Brent crude at $93 to $115 per barrel through Q4 2026, which keeps the Fed on hold, keeps inflation elevated, and keeps the suppression mechanism active throughout the remainder of the year. In that scenario, CryptoQuant's projection of a cycle bottom between June and December 2026 becomes the operative framework. The 2 to 3 week clock is running. History says that when the clock completes, the suppression mechanism resolves. Whether it completes on Trump's timeline is the only variable this channel cannot verify with data. Okay, quick disclaimer. The macroeconomic and geopolitical analysis in this video is strictly for educational purposes and does not constitute financial advice. Trading and investing in Bitcoin and commodities during times of war involves extreme volatility and the risk of total capital loss. Therefore, you must prioritize strict risk management, disciplined position sizing, and your own due diligence, DYOR, before making any investment. These models are probabilistic, not guaranteed, and you are solely responsible for your financial decisions and the consequences of your trades. Stay sharp, use stop losses, and never invest capital you cannot afford to lose. Now let's continue. Price is what you pay. Structure is what you get. And right now, the structure of the Bitcoin market during the Iran war tells a story that is almost completely invisible to anyone looking only at the price chart. The surface story is familiar. Bitcoin closed Q1 2026 at $66,619, down 23.8% from January 1st, according to Crypto News. ETF investors are sitting on an average cost basis near $84,000 against a market price approximately $18,000 below that. Fear and greed sits in extreme fear. The narrative from mainstream financial media is that Bitcoin is range-bound, suppressed by the oil shock, ignored by institutions that have more pressing macro concerns than digital assets. That surface story is accurate. It is also incomplete, because underneath the price chart, a different set of actors has been doing something that has historically preceded every major Bitcoin recovery in the asset's 15-year history. The whale data is the first signal. According to AI Invest's analysis of on-chain metrics from early March 2026, wallets holding over 1,000 Bitcoin accumulated 270,000 Bitcoin over a 30-day window, the largest monthly accumulation by addresses of that size since 2013. That is approximately $20 billion of Bitcoin moved from available market supply into long-term storage during a period when retail investors and some institutional funds were selling. On February 6th, 2026, when the Fear and Greed Index hit 9, a historic low not seen since the FTX collapse, Bitcoin whales executed a single-day transfer of 66,940 Bitcoin into accumulation wallets, the largest 24-hour whale inflow since Bitcoin bottomed at $16,000 in 2022, according to Spotted Crypto's on-chain analysis. The pattern is consistent with what Santiment documented. Wallets holding 10 to 10,000 Bitcoin accumulating, while retail investors sell, a divergence that has historically preceded market bottoms and eventual rallies, according to their own analysis of the 2017 and 2021 cycles. The ETF data tells a more nuanced version of the same story. U.S. spot Bitcoin ETFs ended 4 consecutive months of net outflows in March 2026, pulling in $1.32 billion for the month, the first monthly gain of the year, according to Crypto News. The 4-week inflow streak from late February through mid-March totaled approximately $2.2 billion according to the CC Press and Coin Tribune, with BlackRock's IBIT accounting for approximately $1.7 billion of that total. On a single day in early March, institutions poured $458 million into spot Bitcoin ETFs, a figure investing.com described as a major shift from the outflow trend that had dominated the first 2 months of the year. That 4-week streak was broken in the final week of March as ceasefire hopes faded after Iran denied negotiations, with ETFs recording $296 million in net outflows between March 23rd and 27th, according to the block's flow data. The signal this data gives is not a clean, bullish narrative. It is a market that wants to buy Bitcoin but cannot maintain conviction while the macro suppression mechanism, oil, inflation, Fed hold, remains active. The exchange reserve data provides the most structurally significant signal of the three. According to AI Invest's analysis corroborated by investing.com, Bitcoin exchange reserves have fallen to 2019 levels, a 7-year low. This means that less Bitcoin is available for immediate sale on exchanges than at any point since before the March 2020 COVID crash. When exchange reserves fall, it indicates that Bitcoin holders are moving coins to cold storage, the digital equivalent of taking physical possession of an asset rather than leaving it available for sale on a trading floor. MEXC's analysis confirmed that Bitcoin ETFs in March 2026 absorbed $2.5 billion in new investment, meaning institutions bought approximately 35,000 Bitcoin that moved into cold storage and out of the tradable market. Combined with the whale accumulation data, the available supply of Bitcoin that can actually be sold at current prices has been contracting precisely during the period when sentiment has been most negative. That is the structure of a market being accumulated, not distributed, and it is the structure that has preceded every major Bitcoin price recovery in the asset's history. The bear case on this data must be stated with equal precision, because honest analysis requires it. According to NAI 500's April 2nd analysis of CryptoQuant data, Bitcoin's apparent demand metric, which measures Bitcoin demand relative to newly mined supply, stood at a negative value of approximately 63,000 coins as of the end of last month. The persistent contraction in demand since late November 2025 confirms that the broader market remains in a distribution phase. Medium-sized investors who had been adding positions are now slowing purchases, removing a layer of support. The Coinbase Premium Index has turned negative, indicating that U.S. investors are no longer competing to drive up Bitcoin's price. And according to Coin Tribune's flow analysis, even during the 4-week inflow streak, the institutional machine was described as catching its breath rather than expressing conviction, waiting for a cleaner macro signal before choosing a real trajectory. The whale accumulation is structurally bullish. The retail distribution is structurally bearish. The ETF flows are directionally positive but inconsistent. And the only catalyst that can resolve this tug of war between accumulation and distribution, the only thing that can convert whale positioning into upward price momentum, is a macro environment where the Federal Reserve can cut, where oil normalizes, and where the suppression chain described in Blocodoys loses its grip on risk assets globally. Trump said that resolution has 2 to 3 weeks left. The data from this block says that the people who have been through multiple Bitcoin cycles are already positioned for it. This channel does not give price targets. What this channel gives is a framework, and the framework for this video requires presenting 3 honest scenarios based on what Trump said, what the market showed on March 31st, and what the data from the previous blocks establishes. The scenarios are not equal in probability. They are a structured reading of what the data says happens to the suppression mechanism under each path. Every investor who watches this video will reach their own conclusion about which scenario is more likely. This channel's job is to give you the architecture of each one. Trump's timeline is approximately correct. Discussions produce a framework. Iran opens the strait, or at minimum agrees to stop attacking commercial shipping, within the April 6th to April 21st window that Trump's primetime address implied. The chain of consequences from that resolution is specific and documented. Brent crude falls toward $85 to $95 per barrel. Goldman Sachs' base case for Q4 2026 under a one-quarter Hormuz disruption from its current position above $100. The inflation transmission that has been keeping the Federal Reserve on hold weakens. Goldman's canceled June cut re-enters the conversation. Global liquidity conditions stop deteriorating, and Bitcoin trading at approximately $68,000. As of April 2nd, 46% below its all-time high, in extreme fear territory, with exchange reserves at 7-year lows and whale accumulation at the highest pace since 2013, receives the same type of macro relief catalyst that drove it from $42,000 to $73,000 in 63 days following the January 2024 ETF approval. The March 31st data point quantifies the sensitivity precisely. One unconfirmed statement from a president with limited real power moved over $1 trillion in market cap in minutes, dropped Brent crude 5% in 3 minutes, and sent Bitcoin from $66,000 to $69,000 in a single session. A formal ceasefire from the Commander-in-Chief of the United States, accompanied by the opening of the Strait of Hormuz, is structurally different in magnitude by an order of magnitude. Bernstein reaffirmed its $150,000 year-end target for Bitcoin in a note published March 24th. According to Yahoo Finance, their 3 stated reasons or strategies: continued accumulation, ETF structural demand, and the expectation that the Iran war resolves and macro conditions normalize. Polymarket currently gives Bitcoin a 10% chance of reaching $150,000 before year-end and an 80% chance of reaching $100,000. The latter number representing a 47% gain from current levels. Trump's timeline slips. Negotiations produce headlines but not a deal. The Strait of Hormuz remains partially or fully blocked through May. Oil stays above $100. The Federal Reserve holds at its April 29th meeting and its June 11th meeting. Goldman's adverse scenario, Brent at $93 in Q4 2026 under a 2-month Hormuz disruption, becomes the base case. Bitcoin remains range-bound between $60,000 and $75,000 through Q2 2026. CryptoQuant analyst J.A. Martin's projection of a potential structural bottom in late May 2026, day 777 post-halving, becomes the operative framework rather than a ceasefire rally thesis. The whale accumulation continues quietly. The ETF inflows resume in bursts, but without conviction. The market waits. Bitcoin is not destroyed in this scenario. It is delayed. The structural case, the DOL rule, the institutional ownership base, the halving cycle, remains intact. The suppression mechanism simply stays active for longer than Trump's timeline suggested. The 4-week inflow streak that produced $2.2 billion in institutional buying, then paused during the ceasefire uncertainty of late March, is the preview of what this scenario looks like. Demand exists, but cannot convert to sustained upward price momentum while the macro overhang remains. Trump's April 6th deadline passes without a deal. The U.S. bombs Iran's electric generating plants as threatened in the primetime address. Iran retaliates with proxies against Gulf infrastructure. Brent crude tests $120 to $140 per barrel. Goldman's severe adverse scenario, modeled under a 10-week Hormuz disruption with lasting infrastructure damage. The Federal Reserve faces the worst possible policy environment. Rising inflation from oil alongside falling growth from the energy shock. Bitcoin tests $60,000 and potentially the $55,000 zone that CryptoQuant identified as the ultimate bear market floor based on realized price support levels. Long-term holders and institutional ETF buyers absorb supply. The whale accumulation documented in Bloco, Cinco continues at even higher pace as price falls. The bottom forms at levels that would represent the largest drawdown since the FTX collapse. And then, as in every prior cycle, the suppression event eventually resolves, the macro environment eventually normalizes, and the fixed supply asset with 21 million coins that was accumulated by whales and institutions throughout the suppression period resumes the trajectory that the halving cycle mathematics and the structural regulatory developments of 2026 established before the war began. Here's the data point that anchors all 3 scenarios in a single fact that this channel believes is the most important number in this entire video. Since the start of the Iran war on February 28th, Bitcoin is up approximately 8%. Gold is down 18% since the war began, according to Protos. The S&P 500 is down over 3%. The SPDR Gold Shares ETF, the world's largest gold fund, hemorrhaged $4.2 billion in the first week of the war, the largest weekly outflow in the fund's history, while Bitcoin ETFs were recording their first positive monthly inflows in 5 months. That is not the behavior of an asset that is being abandoned. It is the behavior of an asset that is changing its structural role in institutional portfolios in real time, absorbing the same geopolitical shock that destroyed gold's safe haven narrative, holding at higher lows through every escalation, and being accumulated by the largest wallets in the market at the precise moment when retail sentiment is most negative. CoinDesk documented the rising floor precisely. Bitcoin bottomed at 64,000 on February 28th, 66,000 on March 2nd, 68,000 on March 7th, and 69,400 on March 12th. Each escalation produced a smaller drawdown than the last. That is not coincidence, that is structure. This channel does not know which of the 3 scenarios plays out. This channel knows that Trump gave a specific timeline on national television, that the market has already demonstrated exactly how it responds when that timeline resolves, that the people who have been through multiple Bitcoin cycles have been accumulating at a pace not seen since 2013, that exchange reserves are at 7-year lows, that the halving cycle places Bitcoin in month 11 of its acceleration window, and that the regulatory architecture described in this channel's prior video on the 401k market is being assembled at exactly the moment when institutional retirement capital has its first credible legal pathway into Bitcoin in the asset's history. The suppression mechanism has a name, it has a timeline, and the people who understand the architecture are already positioned for when it resolves. You have the map. The institutions already see the diamond. If you stayed until the very end, I want to personally thank you. It takes real discipline and focus to go through a video like this from start to finish. You're not just watching, you're studying. And that puts you in a very small group of people who actually understand what's being built. Now it's your turn to show you're committed. Comment below with exactly "I see the machine" if you're locked in and ready for what's coming. Also tell me your city and country, what time it is there right now, how the weather is over there. One of the things I enjoy most is seeing how global our community has become. Thousands of people from every corner of the world watching at different hours, all chasing the same edge. Drop your comment right now. I read every single one. Thank you again for watching. See you in the next video, and stay sharp.